Hello and welcome, everybody. Happy Friday, and welcome to the end of a very eventful week, not only for the market, but for the economy as well. This past week was host to the newest update to the FOMC saga, where we got another change to the federal funds rate. In addition to this, we got an updated version of the summary of economic projections, and finally, we got some speeches from both Fed Chairman Jerome Powell as well as the Treasury Secretary Janet Yellen. And while the majority of what we have to talk about today is positive, some of it isn't. So there's a lot for us to recap, but I want to make things simple. I want to boil it down to 5 things. 5 takeaways, 4 positive and 1 negative, that we should know from what happened this week. These are going to be takeaways that are going to be somewhat actionable, but really are meant to give you a better understanding of what happened, some of the reasons why, and how we can take this information and use it in the weeks and months moving forward. So, lots for us to get into, as well as if you're watching this and you're not familiar with the FOMC, or you want a quick refresher, we'll handle that as well. So lots for us to get into. I'm going to quit it with the intro, and let's just get straight into today's presentation, which I'm calling the March 2023 FOMC Review, or 5 Takeaways from the FOMC Meeting. Disclaimer, anytime we talk about historical performance, forecasts, or returns, remember that these are all resources and pieces of education, not financial advice. Past results can never guarantee future performance, and what I'm trying to do today is not tell you how you should think. I'm simply trying to provide you information that I've found and allow you to make a more informed decision based on that. Now, let's cover what we're going to be talking about in this webinar. This past week, on March 21st and 22nd, we had a FOMC meeting. The FOMC is responsible for maintaining a lot of the monetary policy in the United States, and because the market and the economy are connected, we care about this. And this meeting brought with it some changes to the federal funds rate, a speech by Chairman Jerome Powell, as well as an updated version of the summary of economic projections. From this meeting, there are a number of very important takeaways that I want to be able to discuss, which is why this isn't a video, this is a whole webinar. I want to be able to have a conversation and answer or address any questions or concerns that you might have in the process. So we're going to do exactly that today. First, we're going to do a quick refresher on the FOMC, make sure we all know what they are, how they work, and why they work, what role they serve in the US economy, and also set the tone for where things sat prior to this week's meeting. And then, of course, we'll take a look at this week's meeting and also discuss those 5 takeaways from this meeting. Let's start with the basics. What is the FOMC? The FOMC is an acronym for a group known as the Federal Open Market Committee. They are a branch of the Federal Reserve System who are responsible for maintaining the monetary and economic policies of the United States economy. This group, the FOMC, is a really weird acronym. Federal Open Market Committee, even more so. We shorten it to the Fed. Very frequently, if you hear someone say the Fed, they're either talking about the FBI. Not in our case. We're talking about the Federal Reserve System, FOMC. The Fed's job is to monitor the health of the US economy and make changes when those changes are necessary to maintain a healthy economy. And they can do this by changing the supply of money that is available through either issuing bonds or buying back bonds, and by adjusting what is known as the federal funds rate. We'll talk about that more in a little bit. But first, let's talk a bit more about the FOMC. The FOMC is made up of 12 people. 7 are governors from the different Federal Reserve branches. One of these members is the chairman or chairperson of the FOMC, which is the president of the New York branch. The president of the New York branch serves as the vice president for the FOMC. Currently, the chairman of the FOMC is Jerome Powell. The remaining 4 members are district presidents who rotate out on 1-year positions. The main idea here is that these different branches are responsible for monitoring the health of the economy in various regions of the United States. They convene once every so often to discuss the overall health of the US economy and discuss more high-level changes that might be necessary, such as buying back bonds, issuing new bonds, or changing the federal funds rate. The FOMC meets very regularly. They meet 8 times per year, twice per quarter. In each of these meetings, they will review the current state of the economy, and this includes many different factors, such as inflation, GDP, unemployment, cash flow, and, of course, the biggest tool they have, the federal funds rate. In the last meeting of every quarter, these branch chairmen, or the chairman and all the branch members, release what they call the Summary of Economic Projections. It is a very long document in which you get an idea of where each member of the FOMC feels the US economy is headed. These measurements will look at GDP, unemployment, inflation, the federal funds rate, and more in the range of, always in years. They'll talk about 2023, 2024, 2025, and then long term. So that's when they meet and who they are. What do they do? The FOMC has 3 main tools for managing the monetary supply and monetary policies of the US economy. The discount rate, which is the rate at which the Federal Reserve lends to banks. This one they'll touch, but isn't one of their big tools. Another one they have is the reserve requirements. This is determining how much money banks will need to keep in their reserves. This might be a surprise to you, but when you put your money into a bank, they don't just put it into a vault and leave it there. They use your money. They'll take your money and they'll lend it to Juan de los Palotes down the street. And then they might take some of it and invest it. The banks are going to use your money for various purposes. There's a reason that a checking account, an account that you're constantly pulling money out of, putting money into, doesn't really offer you much interest. Because they're not going to mess with those funds as much as they might mess with savings. Money that you're not supposed to be moving around as much. Sure, you'll make some deposits and withdrawals, but it's nothing crazy. So those accounts will offer interest. Not much, but it'll offer interest. But we have to remember, there's no such thing as free money. The reason they are offering you interest on your money in those accounts is because they're using it. When they are using your money, that means that they won't have cash equal to the total amount of everything that is deposited with them. So they are required to keep a certain percent in reserve. So if people start wanting to withdraw their money, and a lot of people want to withdraw their money, they don't run into any insolvency issues, which is where too many people are pulling money, and they're pulling money out faster than the bank can liquidate assets. Those assets could be debt, could be credit, it could be any number of ways that a bank will try and hold investments. It takes time to convert those investments into cash, but if the people want their cash now, we can run into some problems. Moving along, open market operations. This is where I was talking before about buying and selling treasury securities bonds, any form of debt-based security. These are probably one of the most important tools because within these OMOs, or open market operations, this is where they determine or how they tweak the federal fund rate. If you know nothing about the Fed, and if you don't care to remember anything about the Fed, this is the one part to remember. The federal funds rate sits below everything. The federal fund rate sets the price or the interest rate that banks can lend to and from other banks. This rate is set at a target. So the Fed says we want the rate to be this. But the real rate can usually vary somewhere between the actual posted rate and 0.25% above. So let's think about this for a second. Banks are required to have a certain amount in reserve. If they had to make a big purchase, they don't have enough money in reserve anymore. So what they might do is they might go to another bank and say, hey, can I borrow some money? And of course, banks are large institutions that are very reputable and have a very high likelihood of paying back their debts. So these banks, when they lend to and from other banks, don't charge a lot. They'll charge what the federal fund rate is, or maybe a little bit above it. But what happens is when the federal fund rate increases, that increases the minimum that banks will lend to other banks. So when it's more expensive for a bank to lend to another bank, the loans that you, me, and Juan de los Palotes down the street get become more expensive as well. If you've ever looked at a chart and seen the rate for 30-year fixed rate home loans, you'll see that they go up and down quite frequently and by a pretty large percent. Majority of the time, the reason is that the federal fund rate is changing. So when the Fed rate changes, of course, it becomes more expensive for them to borrow money. So they're going to make it more expensive for you to borrow money. What happens is when loans become more expensive, not as many people take out loans. If everyone had the capital to go out right now and buy a house, interest rates are pretty expensive. We're talking somewhere around 7%. Compare that to the end of 2020, when the federal fund rate was about 0, and you could get a 30-year fixed rate loan for under 3% interest. 3%, 7%. And that's just speaking strictly for consumers, for home loans. But businesses borrow money as well. And this also makes it more expensive for businesses to borrow money. So when it's more expensive for them to borrow money, they're not able to build that new building, they're not able to fund that new project, they're not going to expand as quickly, their development is going to slow down, and their spending is also going to slow down. But there's one other part that slows down when everything else slows down. Inflation. I don't think you need me to tell you this. You're probably familiar with inflation. You're probably tired of hearing about it. But I'm going to give you a quick refresher. Inflation is the principle that the value of money decreases over time. Things become more expensive. Go figure. This might seem like a bad thing. It means that gas is going to be more expensive in the future. A burger used to cost 25 cents, now it costs $10. Thanks, In-N-Out. What this means, though, is that things will become more and more expensive over time. The value of $1 is going to decrease. Now, it might seem like a bad thing, but really, inflation is good. we like a little bit of inflation. Because if you know your money is going to be worth more today than it will be tomorrow, and it'll be worth a lot more today than it is 5 years from now, you're more likely to spend that money. And spending money is kind of important for keeping an economy going. We rely on people spending money to fund businesses. The businesses then pay their employees. Employees are also consumers who will go out and buy more stuff. And it's this constant cycle that feeds itself. People spend money. Companies make money. Companies pay people. People then make more money, so they spend more money, and it goes on and on. The Fed actually has a number that is their target for inflation. Around 2%. The Fed likes to keep inflation somewhere in the range of 2 up to 3%. But too much inflation is a bad thing, because the economy can't keep up with that inflation. And that brings us now to where the Fed steps in. Because if the Fed is just sitting by and watching inflation go up, it'll spiral out of control. So, starting around 2022 or so, the Fed started to get pretty aggressive at tackling inflation. They saw that the rate of inflation was skyrocketing in the US economy. To give you a graph, we went from 0% inflation in 2020, plateaued a little bit around 1.5%. Then, as things opened up, the COVID bubble kind of ended, we saw inflation skyrocket straight up to around 5.8%. And around here, in the beginning of 2022, is when the Fed finally stepped in. Inflation was already almost 8%. April 2022 was the first increase to the federal fund rate since 2019. The federal fund rate through COVID was essentially 0%. Remember, yeah, it's not going to be exactly 0. 0.1 means that the Fed target rate was 0, and it was just somewhere between 0 and 0.25. That's basically what that means. We see COVID happened, boom. Fed fund rate dropped to 0 almost overnight. In fact, actually, there was 1 month that they lowered it to 0.5 and then dropped it to 0. It was 0 up until March and April. But as we saw with the other chart, inflation did not end in March and April. It kept going up, peaking at 9.1% in June. What does that 9.1% mean? It means that if you had $1 in June of 2021, that $1 is now worth 91 cents. You lost 9% of your money in 1 year, just from inflation. Means that things became, on average, 9.1% more expensive. Obviously, that's not a good thing. But it's not as easy as just saying, inflation, go away. Lowering inflation is a very long process. It's a very long process because it needs to be done slowly. Because inflation doesn't just fall for no reason. The Fed can't just say, make inflation lower. They need to make changes to the US economy to make it go down, but inflation isn't the only thing that's going to go down. It falls because there is economic recession. Romulo, I'm curious, knowing The market is sensitive to this news. How the increases or decreases are calculated. Is it because investors buy or sell shares? So are you referring to how inflation is calculated? Because the way that inflation is calculated is they look at the price of goods. So they'll look at the price of gas, the price of eggs, the price of milk, the price of electricity, the price of transportation, the price of cars, the price of computers, the price of airfare. They'll look at all of these different things that we spend money on. And there's something that is known as the Urban Consumer Index. This is essentially trying to find a number to define the spending of the average US urban consumer, so someone that lives in cities. That is the metric that is most commonly followed by people like you and me. So anytime you see them talking about CPI inflation, that's that. There are two types, though, of inflation that you'll see: headline and core. Headline inflation is going to include everything. Core inflation is going to take out some of the more volatile types of things, such as food and energy. Long story short, both of those values were extremely elevated. So we were seeing large increases, and some of the biggest industries, by the way, eggs. The price of eggs has gone up by, I don't remember exactly, but double digits in the past year. So it's not so much that investors are buying and selling shares that is driving inflation, so much as it is the price of things is making people stressed out. And then investors are bringing that stress into the stock market because they think earnings are going to tank. Let's check out the symptoms of a recession, and hopefully this will help answer that question. Because here are some of the symptoms of a recession. First is buying power. This is usually the first thing to start happening when a recession begins. We have money. That money's not buying us anything is not buying us enough anymore. Eggs now are double the price. Gas, $6 a gallon. Utilities, good luck. So as things become more and more expensive, people will stop spending money. But they won't just stop spending money on everything, all right? We need to live. We need electricity to live. We need gas to live. We need many things. So they're going to start cutting out other things. They're not going to get as nice of food. They're maybe not going to get a new car. They're going to look at cutting back on their spending. Then what happens is that the federal fund rate increases. The Fed starts stepping in and they make money more expensive to borrow. All of a sudden, companies aren't getting as much income because people aren't spending money as much. And if they want to borrow money, borrowing money is a lot more expensive now. So the easiest thing for them to do is try and minimize their losses, cut back on their expenses, and one of the biggest expenses that most companies have is people. So they're going to start laying off employees. Then, of course, this all goes back into the start of this. They lay off people, which now makes more unemployed people that don't have income. When they don't have income, they're not going to spend as much. They're not spending as much. Companies aren't making as much money. Borrowing money is more expensive. They're going to lay more people off. It starts this death spiral going over and over and over. But over time, that process slowly brings inflation down. So the Fed doesn't just get to say inflation go away. They have to let this process kind of happen, but in a more controlled way than just letting it go in free fall. Now, this again is just an overall cycle of how a recession begins and how it feeds into itself. But let's look at some ways that we can measure a recession. This is a topic that I've covered a lot with Sectors Made Simple subscribers in previous webinars. So if you are a subscriber, go take a look at some of those. If you're not, consider getting one. We do offer amazing financial insights, monthly market updates and market forecasts, as well as create trading strategies and show you how to use our tools to invest simpler. But going back to the recession here, there are a number of ways that we can measure a recession. Unemployment rate. Straightforward. That was literally part 1 of all of this. Part 3. How many people are getting laid off? Then there's company growth. This is going to give us an idea of how much income are these companies generating, how much revenue are they creating, how much earnings are they creating. Then we have GDP, or gross domestic production. How much stuff is the US creating? This is a number that if you had asked someone that just took macroeconomics 101 or took AP macro in high school, you ask them, what is the textbook definition of a recession? They're going to tell you it is 2 consecutive quarters of GDP losses. So GDP goes down 2 consecutive quarters, that is a recession. It's a little bit more nuanced than that. Because if that was the definition of a recession, we would have been talking about this 1 year ago, not today. Then there's consumer spending. This one's a bit trickier, but consumer spending is, as the name implies, how much money are people spending? Economic stability. This one's a bit trickier, but it comes down to a lot of confidence. How confident are people in the system? Do they believe the system is stable? Do they believe the system, i.e. banks, are at risk of failing? And then finally, when we have run out of different numbers to look at, we turn to the people that are making the decisions. People like Treasury Secretary Janet Yellen, FOMC Chairman Jerome Powell, and we look to see what they're saying. What is their outlook? What is their tone? Very frequently, what they say isn't as important as how they say it. We will have these terms, dovish and hawkish speeches. Dovish are very nice, optimistic, the tank is clean kind of statements. Hawkish, much more cautious, much more defensive. So now that we understand who the FOMC is, why the FOMC exists, how they maintain monetary policy, how they try and tackle inflation, and also the risks of trying to tackle inflation, let's take a look at where we sit before this week, where we sat before this week. There are 2 main questions that everyone is probably asking. Are we in a recession, or are we entering a recession? And I've done numerous webinars on this exact topic, and the answer is, it's unclear, it depends, it's tricky. Unemployment remains extremely low. Okay, not extremely low. Unemployment remains low. We are still below 4% unemployment. And if we look at an unemployment chart, which I should have, let me pull up the unemployment rate chart. Let's zoom in to 2008 to now. We saw unemployment decline, COVID happened, skyrocketed, and very quickly dropped back down. we're about at the lowest point for unemployment that we've been since the Great Recession of 2008. So I'm going to call that low inflation. GDP in quarter 4 of 2022 increased by 2.7%. Annual GDP also increased by 2.1%. But company earnings are declining. It's right now we're wrapping up quarter 1 of 2023. It will be ending next week. So the estimates currently for 2023, according to FactSet, which is a study I reference quite a bit around here, is a loss in earnings of 6.1%. That's bad, and it's kind of amplified if we look at where that estimate was at the end of 2022, beginning of 2023. We went from negative 0.3 to 6.1. And most importantly, financial institutions, banks, those that we believe to keep our money safe, have started to fail. Jonathan, do you think this is because there was too much cheap money in the pandemic? That had a lot to do with it. The federal funds rate tanked to zero. Many companies started taking deferred revenue, deferred payments. But we have to remember that recessions are inevitable. We can never truly avoid recessions. The best thing that we can do is try and prepare for them and minimize the damage when they come. These are economic cycles, and these cycles can't be changed. There's an analogy I like to use that maintaining the economy is like being the Forest Service. You have to maintain a giant forest, and wildfires are not a matter of if, it's a matter of when. So the way that you prepare for a wildfire is by doing controlled burns, by clearing brush, you can minimize how much damage those wildfires do, but the reality is wildfires are required. They are a necessary part for us to be able to grow a bigger forest, a healthier forest. It clears out old growth, it makes room for new growth, it resaturates the soil. These events that are destructive are still part of a necessary cycle for a healthy thing. And it sucks, but that's the truth. That we can never avoid recessions, we can just try and minimize the impact of them and learn from them. So do I think there was too much cheap money? Yes, but again, recessions are unavoidable. We're going to have them at some point. It was either now, 2 years from now, a year from now, whenever. It was going to happen at some point. Now, you probably heard this phrase before. Can banks be too big to fail? First, let's define failure for a bank. This means that a bank either has more debt than it does assets, so they owe more money than they have money, or they don't have enough money to meet the needs of the depositors, the people that have money in that bank. So this might be a bunch of people are trying to withdraw their money. This might be they had stock that tanked and lost all of its value. Wherever it might be, a bank failure basically means that they don't have enough money and they can't get enough money. And in the past 2 weeks, we've seen 2 banks fail. The first was Silicon Valley Bank. This represented the largest bank failure since 2009 and the second largest bank failure in US history. And then the second was Signature Bank. Between these 2 banks, they held $320 billion in assets. $264 billion of that was in deposits. People that put cash into those banks. Now, why does this matter? It should be obvious. If a bank fails, the immediate question is, do I get my money back? If a bank is holding your money and the bank closes, can I still get my money? And the answer is yes, up to a certain point. You see, most, if not all, reputable banks are insured by the FDIC, the Federal Deposit Insurance Corporation. If a bank is insured by the FDIC, deposits in that bank per person, per account, are insured up to $250,000. Decent, right? Probably covers the majority of us that have money in a checking account. $250K. But let's look what happened to Silicon Valley Bank, or good old SVB. So Silicon Valley Bank failed and was taken, the control of the bank was taken by the FDIC. Both the FDIC and President Biden issued statements saying that the FDIC will fully insure the depositors of Silicon Valley Bank. What that fully insure means is that they're ignoring that $250,000 limit. If you had money with those banks, didn't matter if it was $1 or $1 billion, it's insured. You're safe. Good deal, right? So, while there are likely many reasons that they stepped in and made that big change, here are probably two of the biggest reasons, in my opinion. The first and biggest, avoid panic. Most of us, if not all of us, remember what happened in 2007 to 2009. We remember the housing crisis. We remember the subprime mortgages. We remember banks failing left and right. We remember an almost $1 trillion bailout package. We don't want that to happen again. And that is fresh in our brains. So people are ready to panic. So the FDIC and President Biden stepped in to say, look, we are fully insuring all depositors. No one is losing their money. Hold on faith in the banking system and the US economy. But the second reason is to protect businesses. Remember that whole death spiral that I was talking about before? This could cause that. Because Silicon Valley Bank was not a consumer bank, per se. Many of the people that had accounts and had deposits at Silicon Valley Bank are major companies and Silicon Valley startups. By fully insuring all deposits with that bank, what the FDIC is trying to do is minimize the damage to other consumers, but more importantly to other businesses. These businesses are crucial to keep afloat, because if one bank fails, that's one thing. But if a bank fails and brings down 300 other companies with it, that's really bad. So they stepped in. They're going to fully cover everyone's deposits, and everyone will be made whole. All of the depositors will be made whole. Sorry. So why does this matter, and why have we spent so much time talking about all of this? Because, I'll spoil this right now, all of this is going to lead to the fifth and largest point on my list. And that these bank failures have sent some massive shockwaves through the financial sector. The S&P 500 Financial Sector ETF has dropped 14%. Regional banking got hit even harder at 30% loss. Even stable banks, banks that have no risk of failure, are completely shored up 15 to 25% loss. And outside of the financial sector, what we're finding is that the solution for fixing these problems is that the Fed wants us to think they're in control. The FDIC wants us to think that they're in control. And we believe them. I still do believe them, that that is the case. The reasons that we saw bank failures in 2008 are not present right now. Someone might point to say, look, right now it's auto loans. we're seeing a massive spike in auto loan, subprime auto loan defaults. That number is not any higher than it's been throughout the 2010s. Not cause for concern. But I'll talk about this a little bit more because all of this point will come to a pass in point number 5, where we realize why the market is still losing their minds. Well, now let's talk about this week. On Tuesday and Wednesday, the FOMC met to discuss the current state of the economy and what changes they want to make to the policy and the federal fund rate. And to break down this meeting and why it matters, historically, I've gone through and read through the entire summary of economic projections. I'm not going to do that today. I'm going to make it simple. We're going to cover 5 points, and with each point, I will summarize it with a big, bold section to tell you why you should care. Sound good? Let's do it. First, federal fund rate. What do? They increased it by 0.25%. Now, prior to any of this banking industry nonsense, analysts were basically in agreement that we were going to see either a 0.5%. Some analysts and myself were kind of of the opinion they're going to increase it by 0.75%. But given the current state of the financial sector, increasing this federal fund rate by a significant amount, probably not a good idea. So the Fed completely changed their plans and only increased the federal fund rate by 0.25%. That now brings the current Fed fund rate up to 5%. Interestingly, and this holds absolutely zero weight, this was something just said in passing. Jerome Powell said that it is certainly possible that the Fed fund rate stays below 5%. This statement, by the way, February 1st. Less than 2 months ago. Kind of interesting, right? But where do we go from here? How do we take this information and use it? Well, the federal fund rate portion of it, what we need to do is we need to look at the summary of economic projections. I'm going to reference it a lot throughout this webinar. I will show you it right now. It is 17 pages long. It is a lot of box and whisker plots and histograms. I'll put the link in chat and in the resources if you're interested. If you don't like statistics, it's a really boring read, so I'm going to help you get through it. From 2023, so by the end of the year, the Federal Reserve, all of the members of the FOMC, put in their perspective, put in their opinions. And their opinions ranged from 4.9% to 5.9%. Compare that to December. Again, once every quarter we get this update. So from December of 2022's Summary of Economic Projections, we have the same floor of 4.9%, and the maximum, the highest estimate, has gone up from 5.6 to 5.9. But the Fed is still pretty undecided on how long these rates will remain high, because the 2024 estimate has a range from 3.4 to 5.6%. Basically, some people think that it's going to drop 1.5%, while others think there's going to be basically no change at all. What does this mean? Again, told you I'd make it bold. What this means is that we're likely near the top of these federal fund rate changes, but we shouldn't expect them to disappear overnight or anytime soon. Even at the most liberal of these predictions, we're still looking at 3.4%, which again is not low by any stretch of the imagination. That is still high. Point number 2, GDP growth will slow. GDP growth, as I mentioned before, in quarter 4 increased by 2.9%, I believe. In 2022, calendar year, it increased by 2.1%. And in the most recent Summary of Economic Projections, the range of estimates for the GDP of 2023 is between negative 0.2 and 1.3%. Even with the best estimates, this still means that it's possible to see quarterly GDP growth that is negative. Now, unfortunately, the Fed doesn't break down their estimates quarter by quarter, so I wanted some other data to talk about here. Because again, I love looking at annual stuff, but guess what? We live day to day, second to second. I want to give us something a little bit more useful, okay? February 2023, FactSet put together their final update for their most recent round of earnings. Again, these studies are amazing for the breadth of information they provide. FactSet, if you're watching this, thank you. But in their report, they find that the projected earnings for quarter one of 2023 is negative 6.1%. Mind you, earnings is not the same thing as GDP. It is not the same thing. These are not correlated values. There's no direct correlation, rather. But what this basically means is that companies are going to be losing earnings. And quite a bit of them. So we're going to see quarterly losses of 6.1% for quarter one, which is what we're wrapping up right now, by the way. And then negative 3.8 for quarter two. But then, in the second half of the year, they predict earnings. Or they predict growth. Show you the exact numbers. They estimate quarter two, 3.8% loss. By the end of the year, quarter four, they're predicting almost 10% gain in the earnings growth for companies, giving us a total growth for calendar year of around 1.9%. That's not great news, but it's good news. Because what that means is that GDP and earnings agree that we're going to see economic pullback through the first half of 2023, quarter one and quarter two. Before you start thinking that we're about to have 6 months of nothing but stormy weather in the economy, remember we're already halfway through this. The worst of what they expect is quarter one. And quarter one is done. Point number 3. Again, when we're looking at recessions, when we're looking at how much damage are these events doing, we look at unemployment. Because when it comes down to it, unemployment is where that's what lets people live. That's what generates revenue for people, how they get income. And thankfully, unemployment is still expected to be low. So historically, recessions have seen an increase in unemployment, where in the past 70 years, the lowest peak unemployment was around 6%. So in historical recessions, when the inflation gets to its top point, it's been around 6%. Currently, the range of estimates, so the best and worst estimates, are somewhere between 3.9% and 4.8%. That's for 2023. 2024, they're expecting unemployment to continue to rise. So, 2 estimates, only 2 people, by the way, out of all of the FOMC members, believe that it would be above 5%, with 2 people voting that it's going to be around 5.2%. But let's step back for a second here. 2023, when people are saying the recession is going to happen, unemployment will not be anywhere close to as bad as it was in a true recession as we've seen in the past. So what this means is that whatever recession, whatever economic pullback we see, is anticipated to be pretty mild and will not severely impact unemployment. Point number 4. Inflation is expected to decline. And that's supposed to start pretty soon. And by that I mean it's already happening. Inflation is projected to decrease towards 2 to 3% by 2025. This isn't directly news by any stretch of the imagination. 2025 is pretty far from now. Jeez, I'll be turning 30 then. Anyway, not the point. The point is that by reaffirming that they believe that inflation will continue to decrease, what the Fed is saying is that they'll be able to do their goal. They'll be able to complete their work of getting inflation back under control without throwing the US into a deep recession, without causing long-lasting damage in the US economy, and without severely impacting how many of us have jobs. That is really great news. That's basically saying that they are fully confident in their ability to get the US economy back on the correct path with inflation, without without unemployment going up to that 6% level that we've seen in previous recessions, in the best case of scenario for other recessions, but also keeping things well under control. Now, we've covered the 4 points, and I told you the 4 first ones are going to be good news. The last one isn't. But I want to quickly get your thoughts on what we've talked about so far. What is your opinion of the first 4 points that we've covered? That inflation is expected to decline, we saw a 0.25% increase to the federal fund rate, and we don't expect it to go much above 6%. That GDP growth will slow in the first half of 2023, but still expected to be positive by the end of the year, and that unemployment will remain low. And yes, it will increase, but it will not get anywhere close to the 6% line that we've seen in historical recessions. So what are your thoughts? We're still going to feel a crunch? We've been feeling a crunch. We've been feeling a crunch, I'll tell you that much. All good. Now, here's my opinion. These 4 signals that we've talked about, these 4 takeaways, should indicate that we are going to see pullback. So don't be surprised if earnings this quarter are terrible. If we see that earnings next quarter are not great, the forecast predicts this. But in the mid to long term, things are moving in the correct direction. We're getting inflation back under control. The banking sector is still pretty healthy, and that we'll be able to get all this back on the correct path with minimal collateral damage to things like unemployment. Now, the market didn't agree with me. The market got pretty upset after the FOMC meeting, then rallied Thursday morning, only to crash back down again on Thursday afternoon. So why? Well, we got to talk about the last part, because now we've talked about the FOMC meeting, we've talked about the summary of economic projections. Let's now go talk about Chairman Powell's speech and another concurrent speech that was given on Thursday by Secretary of Treasury Janet Yellen. And to talk about this, we need to go back to that whole story I was talking about before, about the current state of the banking industry. The financial sector as a whole has had massive cracks sent through it. And this is not limited to the United States. Deutsche Bank, German banks, and international banks that are pillars of the global economy are feeling the pressure and are running into issues. So we're finding that the increase in overnight rates due to the federal funds rate and increased withdrawals from people panicking and losing faith in the financial system is putting massive strain on the financial industry. In separate speeches, both Chairman Jerome Powell and Treasury Secretary Yellen spoke regarding the state of the banking industry. Immediately, and as we've covered, the first thing that people are going to think about is the global banking crisis in 2008. And to calm your worries right now, both officials stated that this is not going to be the case. We will not see a crash like 2008. We will not see widespread bank failures due to subprime loans or anything like that. We learned the lessons, we've improved, and this is showing the signs of that. Yes, we are seeing stress. We are seeing cracks. And through those cracks, some of the weaker points are leaking. But the overall health of the financial sector remains strong. But why the heck are markets still falling? Well, 5.5 now. Because the FDIC's generosity to save these banks might run out. When Biden first spoke to calm everyone's fears regarding Silicon Valley Bank, he reassured the public that the FDIC would step in to cover all depositors. They did the same thing for Signature Bank. And we love this. It's a great reassurance that things are going all right. But then Powell and Yellen both made one comment, both of them made the same comment, and it sent everyone into a panic. They both stated that the FDIC would not universally cover uninsured deposits. And uninsured deposits here, by the way, is not saying deposits in uninsured banks. That is saying money that is above $250K is uninsured deposits. So they will not cover uninsured deposits universally, and that they would only do so if, quote, failure to protect these uninsured depositors would create systemic risk and significant economic and financial consequences. The Mayan calendar was a little bit less doomsday than that. But basically what that means is that we shouldn't expect the Fed to just cover our butts universally. If more banks fail, they will not step in to protect all of the assets at every single bank. And of course, the stock market panicked. Go figure. But where does that leave us? As investors, where does this leave us? Well, unfortunately, it leaves us to wait. There are a number of factors outside of our control that are currently driving the stock market. There's the possibility of more bank or creditor failures, the very high likelihood of poor Q1 earnings, drop in investor confidence that has kind of emphasized and amplified negative trends in the market, and elevated volatility that is making these changes even larger as uncertainty reigns supreme. So what should we do? All of this, by the way, my opinion. In the short term, remain cautious and aware. We're not expecting any significant economic bombshells over the next few weeks. We will get unemployment data for March in April, and unemployment data in April, but for now, we can breathe a sigh of relief. What will be coming up in late April is earnings. As earnings begin to start, these earnings will very much sway the market as companies realize what their situation is and share those situations with us. And that will give us a true insight into how this economic downturn has affected the companies that we invest in. Now, mid to long term, we don't have much to worry about. We will not see widespread market failure. We will not see widespread banking failure. We will not see widespread homelessness due to defaults. And also, we got to remember one thing. Everything we've talked about today is the economic cycle. There is a market cycle and an economic cycle. And just as the market cycle and the economic cycle will always have its ups and downs, always have its growth and recession periods, the stock market will always lead the economic cycle. What that means is that as investors, a bull market begins in periods of economic pullback, also known as recessions. And that trend, that beginning of a bull market, is typically somewhere in the range of 6 to 12 months prior to the beginning of economic recovery. If we look back to see what was around 8 to 10 months ago, it was October of 2022, which still to this day was the bottom of the bear market. And since then, we have seen recovery, pullback, but overall, we're moving in the correct direction, and this too shall pass. So remain cautious and aware, but remember that we should have confidence in the system, that all of this is part of the process, and that we're unfortunately and fortunately just along for the ride. But hopefully today has given you more insight as to what's going on, why it matters, the key takeaways, and most importantly, how we should use this information to inform our overall view of the market and the economy. So thank you all so much for joining us in this webinar. It was a pleasure to get to put all this information together for you and present it in a way that brings it back down to earth and makes us understand this entire situation a little bit simpler. Thank you all so much. If you have any questions or want to reach out to us, you can always reach us at support@sectorsmadesimple.com. We'd love to hear from you. Also, while you're here on our YouTube channel, we would greatly appreciate a like on this video and a subscription to our channel. Totally free and a great investment in your financial education moving forward. So thank you all so much. Take care, have a great weekend, and bye.